Hello and welcome to this session in which we will discuss the Professional Judgment Framework by the Center of Audit Quality, or CAQ. What is a professional judgment? Professional judgment is when you make the best decision under the circumstances given your accounting principles knowledge, your auditing techniques, your knowledge/experience of the client and the industry. So as an auditor, you have to make decisions that they don't follow a specific sets of rules. You have to make a judgment, a professional judgment. So the professional judgment is when you use all your knowledge, your accounting knowledge, your auditing techniques, your experience with the client, your experience in the industry. In the prior session, we looked at something called professional skepticism. When you are making a professional judgment, you have to use professional skepticism, which is a crucial part of the auditor's professional judgment. So I just want to let you know that professional skepticism falls under professional judgment. Now, to help auditors make sound professional judgment during an audit, we have this Center of Audit Quality, and that center is affiliated with the AICPA. Surprise, surprise, has established a framework of 5 components that outline a systematic decision process. And this is what we'll cover in this session. So this framework is designed to help auditors thinking, helping them become more aware of their own biases, judgment tendencies, and traps, because the auditors might get traps by their own biases. So we want to make sure the auditors are aware of their own tendencies and traps, thereby promoting more objective and reliable auditing standards. So in this session, we would look at the framework. There are 5 parts of it. Then we will look at the 4 typical tendencies or traps that the auditors may fall into and how to mitigate those traps. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. The 5 components of the professional judgment framework are: first, you identify and define the issue at hand. 2, gather the fact and information and the relevant literature that's going to help you. Perform analysis and identify potential alternative. Make a decision. Then review and complete documentation and rationale for the conclusion. Why did you make that decision? And you're going to see how we're going to go over each step separately, starting with step 1. Step 1 is identify the problem. Identify and define the issue. What are we dealing with here? The auditor will start by clearly identifying and defining the issue through a thorough analysis of the situation and its potential impact on the audit. What am I dealing with? Here, the auditor should consider the issue's effect on the financial statement. What effect does it have on the financial statement? How complex it is, and the uncertainty of that issue and the impact on the audit procedures. For example, let's assume we are looking at an unusual sales transaction. So this is the example we're going to be carrying on through the following 5 steps. The auditor should consider the transaction validity as revenue. So the issue is this transaction a revenue, an actual revenue? Is there any special valuation concern? In other words, do we have to look at the figures? Is the figure of the revenue correct? Is it correct? Is the amount correct? And any necessary disclosure that we have to include with that transaction. So that's the issue at hand. What do we do next? After we identify the issue, we gather and understand the relevant facts. Now we look at additional information, relevant facts, and information about the issue. Then we would look at relevant accounting and auditing standards. Now we know what the issue is. It's revenue. Now let's look at GAAP and GAS to deal with from an accounting perspective and from an auditing perspective. How do we approach this issue? So here the auditor may review the contract itself, looking at relevant facts, because in the contract we learn more about the sales transaction, delivery documentation, discuss the rationale with management, Why is it a revenue? Why is it not a revenue? Evaluate the revenue recognition compliance with GAAP or any other reporting framework. We're assuming here we're using GAAP. Then we will use our auditing knowledge to proceed. Step 3, we're going to perform analysis and identify potential alternative. This step involves understanding the transaction. Now we understand the transaction. Checking the client consistencies and applying authoritative literature. Are they treating the same transaction constantly, or are they treating this transaction differently than others? Are they consistent in the revenue recognition? Verifying key facts and assumptions. What assumptions are they making? What facts do we have on hand? And identify any discrepancies in the company's rationale. Here, the auditor might assess if it meets the accounting criteria for revenue recognition, if there's any conflicting information about its inclusion in the financial statements. Do we add or not? After we analyze and identify potential alternative, we have to make a decision. Now the auditor uses their judgment at this point to make a decision. And when you make a decision, you might have one alternative, a single appropriate response, or you might have multiple reasonable options. You have to choose the best alternative. So following the decision, the auditor reviews the judgment process to ensure all key steps were properly executed. Here, after evaluating this unusual sales transaction, the auditor might decide whether to record this transaction or not, whether recording align with accounting standards. If it is, we're going to go ahead and do what? Record the transaction as sales. Now, once we make this decision, we're going to make kind of a review decision. What is a review? Well, it says review and complete documentation and rationale the conclusion. So after you make the decision, you review it. You document your rationale. Why did you come up to this conclusion? Now, here's what's going to happen. As the auditor document the rationale, they may identify that the reasoning seems faulty or incomplete, and thus convincing. So at this point, they might say, we might have made a mistake. Or they might say, great, based on our rationale, the judgment was correct. And this is going to prompt the auditor to reassess, if needed, the analysis and the judgment process. Hopefully at this point, all we're doing is we are documenting our rationale. But when you document, when you write things out, guess what's going to happen? You're going to kind of test your own logic. So this is basically for the auditor to test their own logic. Document your own reasoning. And maybe you'll find a discrepancy in your own reasoning, or maybe not, or you might say, great, what I did is great. So documenting the process helps the auditor maintain objectivity and thoroughness. You're going through the process again and assessing the reasoning. So basically, they are kind of testing their own reasoning. That we did the right thing, map it out. And hopefully the answer is yes, we did. Now, this is the framework. Also within the framework, they talk about potential judgment tendencies, traps, and biases. So the framework highlighted judgment, tendencies, traps, and biases. It means mistakes that we commit without even knowing. And the framework outlined various strategies that can be implemented to reduce the impact of those biases or traps. What are those biases? The confirmation bias, overconfidence bias, the anchoring bias, the availability bias. So being conscious of these biases, of these pitfalls, it's going to enable the auditor to act proactively to lessen the impact and strengthen professional skepticism and professional judgment. So what is the confirmation bias? What's a confirmation bias? What's the tendency? It's the inclination to give greater emphasis on the information that aligns with one's initial belief or preferences. Confirmation bias is you think the issue is X, and what you do is you look for information to support your initial tendency, your initial belief, or your initial preference. And this is what you do is now you look for evidence or data that's going to be aligned to your belief. This is what the confirmation bias. How should you mitigate this? Strategy to mitigate: present counter argument and explore alternative interpretation. Say, you know what? Let me take a look at it from a different perspective. Maybe this is not what it's supposed to be. So take into account information that might refute or contradict your initial position. So I don't think this is going to be revenue. It doesn't look like revenue. The second bias is overconfidence. And we all know what overconfidence is. You know it all. The tendency to overvalue your judgment capacity to execute tasks or to make precise evaluation of risk or other judgment and decision. You know it. You don't need any second opinion. You know it all. Well, how should you mitigate this risk? Question yourself by examining your assumptions and ask for a second opinion, a third opinion, either within your own firm, with another partner, with another manager, or if you have to consult with an outsider. Don't have the overconfidence bias. Anchoring is when you focus on one thing and you ignore all the other fact. The tendency is, the inclination is to begin evaluation with an initial value, then inadequately adjust away from that starting point. So simply put, you know what? I'm going to focus. You look at one thing, sales went up, or the company must be doing good. Well, sales went up, but maybe expenses went up higher. You're just focusing on sales. You're anchoring. Then you don't adequately adjust away from that point. You just assume the company is growing. Maybe it's growing at the expense of advertisement. Maybe it's growing at the expense of profit, but you're anchoring. You're focusing on one thing. A good thing, another example of anchoring, for example, you wanted to buy a car and all what you look at, it's low mileage, okay? And you would say this car is good because it has low mileage. Well, it has low mileage, but what if this car was a rental car? People that drives rental car, they really abuse the car. So low mileage doesn't mean anything. How about if this car was in an accident? Well, if it's an accident, even though it's low mileage, well, it may not be the best option for you. But you're focusing on the low mileage and ignoring everything else. What you should do under anchoring, seek and accept perspectives from others. Strategy to mitigate, evaluate the possibility of management bias, including the potential for fraud or significant inaccuracy. So you're looking at one thing and ignoring everything else, anchoring. Availability. Here what you're doing is you're looking at information that's readily retrievable or easily accessible. Because the information, the answer is easy, you would rely on this information. You don't make an effort to look at other information. The information is available. Let's move on. This is the availability bias. What should you do? Reflect on the reasons why certain information is at the forefront of your thought, or why is it available? Why am I thinking like this immediately? Maybe there's something else to it other than what I'm saying. Acquire and evaluate objective data, additional data, engage with others for input, and present a counter argument for your initial position. So always, when you want to mitigate your biases, play the devil's role. Either play it against yourself or ask someone to play the devil's role, so this way you don't fall into your own biases. Let's take a look at a multiple choice questions from Farhat Lectures. All the following are steps in the professional judgment process according to the Center for Audit Quality, except there's one that's not. One is not. So 3 is yes, 1 is no. Okay? So identify and define the issue. I would say yes. First thing, you have to identify and define the issue. That's a yes. Therefore, it's not the answer. A is out. 2, considering the accounting and auditing standards and rule relevant to the issue. Do you have to consider that? Of course, when you're analyzing an issue, you have to consider accounting and auditing standard. That's out. Identifying an appropriate response to the issue. Do you have to identify a response to the issue? Okay? Yes, you have to. At some point, you might have one response or several options. You have to identify an appropriate response before you make a decision. Yes. So by process of elimination, the answer is D. Determining the appropriate audit opinion to be issued. Well, is this one of the steps help you issue an opinion? Not at all. The Center for Audit Quality, it's going to help you identify the issue, consider accounting, analyze the issue, identify the appropriate response, make a decision, then document the decision. It has nothing to do with your audit opinion. Determine which audit opinion you're going to be issuing. Therefore, A, B, and C are. D is not, and D is the correct answer. What should you do now? Go to Farhat Lectures and look at additional MCQs, true, false, notes, additional resources, whether you are a CPA exam candidate or an accounting student. Good luck, study hard, and of course, stay safe.